So good morning again. Welcome, distinguished ladies and gentlemen. It's a real delight to see you. It's my absolute delight to welcome you online as well. We have a few people joining online from around the world and in Nigeria, as well as those in the room, to the ARM 2025 Economic Outlook Conference. I think that definitely warrants a round of applause. As you know, the first quarter of any year is always busy with lots of outlook events. People want to position and know exactly what the year is going to pan out to be. For those of you who may not know me, my name is Rolake Akinkunmi-Filani. I'm an executive. I have a passion for driving growth and innovation in the energy infrastructure and finance space, but I'm also fortunate to be a media anchor. I anchor Business Week on Arise News every Saturday at 10. Please do watch. So I take delight in bringing forward critical conversations and helping us make sense of global economic and local business trends. Interesting trivia, I also happen to be a former employee of the ARM group, but if you want to find out a bit more about that, we can talk over coffee or during the networking. So, we've all had our dirty December, and now we're gunning to go. Of course, inflation was at 34.8% in December. Go figure. The dirty December month. But the theme of today, identifying, we have Moronke Bangbala, Managing Director of ARM Trustees. I did spot her. Yes, there she is. And of course, to all members of the ARM team, organizing and technical, who've made today possible. And on that note, I'd like to welcome, to give some opening remarks, the Deputy Group CEO of ARM, Mr. Wale Odutola. We have one of our guest speakers who'll be joining us online. And it's a very timely, actually, participation by him, because just yesterday, the ARM team group and the Ministry of Finance Incorporated launched the Series 2 of the Real Estate Investment Fund. Many of you would have heard about it, and I'm sure he can tell us a bit about it. But he's none other than Dr. Armstrong Takang, the CEO of the Ministry of Finance Incorporated, and who will discuss the outlook and the role of public-private partnerships in bridging Nigeria's infrastructure gap. So I'm going to go back to inviting Mr. Wale Odutola, the Deputy Group CEO, to give some opening remarks. A round of applause for him. Thank you.
Thank you, Rolake. Good morning once again to our guests. And sincere apologies for the late start. As Rolake mentioned, technical difficulties as well as us stylishly waiting for the room to fill up. So apologies for the late start. But I'm certainly confident that you will have a fruitful time today with us, and hopefully the conversations we have today will help you plan your 2025. As an introduction, and as I am sure a lot of the guests here may not know who I am or we've never had any encounter. Up until a few months ago, I led the pensions business for ARM, which I did for 10 years. Altogether, I've been with the firm, I think, 28 years now, half a lifetime. So I do know a bit about the history of the company. And as in all things, I've gone through a number of seasons with the company. And the conversations we'll be having today are entirely based on this season that we're at as a country. But you would also hear a lot of that overlaid by ARM and the season ARM is at, and our strategy for the future going forward. So in as much as we'll be speaking to you about the economy and what we think you should be thinking or we think you should be doing in this time, we would also be talking stylishly about the strategy for the business and where we are going as a company, and inviting you to join us on that journey as we go forward. So that, in a nutshell, is the objective of this session. I'm quite confident that we will have very good time talking about very important things to all of us. You do have a commitment, though, that as we have these conversations, rest assured that we are committed to helping you realize those ambitions. You have those financial goals, you have those targets that you have. That is the work that we do, and that is why we're here. We're here for you. So just reiterating that commitment to you. Thank you once again, everyone. Thank you for joining us promptly. And I will invite Rolake back. Thank you.
Thank you very much, Mr. Wale Odutola, Deputy Group CEO of ARM. Okay, so I think we can move on now to having our guest speaker online. Thank you again for joining us. We appreciate you taking the time out of your very busy schedule. We have a room full of perhaps almost 100 people, if not more, and we have many more online. And what we'd like to do is just talk to you about your thoughts on some of the initiatives that you're doing and the contribution to the Nigerian economy and the infrastructure landscape. Of course, you'd have to be living under a rock in this room not to have heard of the Ministry of Finance Real Estate Investment Fund, which you launched last year. And of course, Series 2 came out yesterday. It's the 250 billion naira fund. So I guess my first question to you, Dr. Takang, is, given the well-known infrastructure deficit we face, the RIT is just one way, the REIF actually is just one way of addressing this. But what role do you broadly see for public-private partnerships in trying to address the infrastructure gap and deficit?
Well, Rolake, thank you so much, and the ARN family. It's a pleasure to be joining you in this conversation. From my perspective, I think you've clearly the point of infrastructure deficit is something that has been with us for quite some time. There have been several attempts to try and address it. And if you recall, several years ago, there was a study and a plan that spoke to the fact that we would need about $100 billion every year for the next 30 years to be able to bridge that infrastructure gap. And if you think about how much our budget is, our national budget, even if we were to dedicate every amount of money we budget by the federal government, both recurring expenditure and capital expenditure every year for infrastructure, there is no way the public sector alone can address that infrastructure gap. So what that really means is that we need to become more creative in finding other partners to work with to bridge that gap in terms of mobilizing the capital that is needed. And that is where the idea of public sector partnering with private sector comes in. And how would that happen? One is to partner with private sector in terms of mobilizing capital at scale to address the infrastructure gap across the various sub-infrastructure segments, whether it is in terms of roads, houses, telecommunications infrastructure, sewage, rail network, the whole gamut of it. And so we need to be able to find mechanisms, we need to find financial instruments and processes that will allow us to come together as a public sector partnering with private sector to mobilize capital at scale to address that. But the second area that we see as the basis for that partnership is around the capabilities and the experience for delivery. Because it is one thing mobilizing capital, it's a whole different thing being able to execute on that mandate in terms of being able to, what is it going to take for us to design the projects for that infrastructure, whether it is a rail network, it's a road network, telecommunications infrastructure, housing, all of that you need to be able to design the studies and the projects themselves so you can determine the feasibility of it. You do the environmental impact assessment, you are able to determine what, the financial resources that are needed. And a lot of work needs to be done. That is another area where we see private sector playing a key role in terms of things such as even financial advisors, technical advisors, legal advisors. Those are capabilities that we expect private sector to bring to the table to be able to make this come alive. And of course, once the project has been designed, there is the issue of execution, implementation. Again, that is an area where we expect private sector to participate in delivering on that. And then finally, once that infrastructure has been delivered, we need to think about the O&M, the operations and the management of that infrastructure to make sure that, one, it is sustainable, we are able to put it to use, collect the charges, the levies or the fees that are needed to, at the very minimum, maintain that infrastructure to also contribute towards the repayment of any debt obligations that is available. On the public sector side, clearly for infrastructure, we see that as requiring patient, long-term capital that usually is cheap. Most private sector companies will find it extremely difficult to have access to those resources. Sovereign or public sector, on the other hand, has that from the DFIs, whether it is the World Bank, it is African Development Bank, Islamic Development Bank, and most of the international DFIs were established to provide that type of long-term patient capital for infrastructure projects. We can have access to that, but we need to access that in a way that allows us to put it to use so that we get the results that are required. And so that's where we see the partnership between public sector and private sector. And it is also on the back of that we established the Mofi Real Estate Investment Fund as a PPP. Again, how do we bring public sector and private sector together and create a blended rate for financing of the demand side of that equation, which is really providing mortgages, a low rate of mortgages, in fact, affordable mortgages, long tenure, 10, 15, 20 years, 25 years, depending upon the age of the applicant, and also the ability to pay for it, and then finally at scale. And that's why we're very glad about our partnership with the private sector on the MREF, especially ARM, because ARM, through a competitive process, emerged the fund manager for this unique fund that we believe is going to be quite revolutionary, and it's clearly a demonstration in practical terms of how public sector and private sector can work together.
Okay, thank you very much, Dr. Takan. Please give him a round of applause. I think it must be said that the partnership is indeed a formidable one. You already touched on part of what was going to be my next question around the reef, but I think for many Nigerians, the infrastructure issue has been a big one. And when we look at the affordable housing space, for instance, we talk about a 20 million unit housing deficit. And you've described both the long-term issue around tenure for infrastructure financing as well as the low-cost financing. Is the vision of the RIF to actually remove that housing deficit? Do you have a target around it? What is the real aspiration behind that? And then secondly, layered to that is this model replicable across other types of infrastructure asset classes?
Thank you very much for that, Rolake. I think the key thing is we're quite clear. If you read our long-term vision, we started from the basis that for us to truly bridge the gap that exists, we have to have the capability to build between 700,000 units to 1 million units every year consistently for several years to come. So get very close to bridging that gap. We may not be able to, eliminate the gap, but to bridge it and make sure that that gap is much smaller. We have to be building between 700,000 to 1 million units every year. That was the tenet upon which the MREF was formed. But we also recognize that you're talking about a huge amount of money that will be required to achieve. Public sector alone can't do it. Neither can private sector alone. So we believe very strongly that for us to be able to create a process, to create the financial instruments, to create the ecosystem and the partnership that allows us to bridge that gap, we need to find mechanisms that will bring both public sector and private sector together. And why is that important? If you think about it, from the mortgage side, you can't expect that mortgage system to function if those who are applying for mortgages have to go to commercial banks and borrow money at the moment at 30%, and maximum you're going to get is maybe 5 years. It's just not going to work. We need to be able to get to the point where mortgages are available at close to single digit as possible. And people are able to get mortgages at least with a tenure of at least 10, 15, 20, 25 years. And also it has to be at scale so that as many Nigerians as possible can have access to it. That's the only way you can begin to attempt to address that deficit. And so what did we decide to do? Our view is based on the philosophy that as government, we have a fundamental responsibility to put in place mechanisms, structures, the financing to grow the economy. And we see the housing sector or the real estate as being a key mechanism to grow our economy. And so we have a responsibility to contribute towards that. And one way we see that is by saying, can we contribute in the area of mobilizing financing at scale at very low rate, concessionary rate, which is why the portion of government that is coming in at a very low interest rate. And the idea is to now blend it with the rate of the capital from the private sector, which we do not expect them to give us for free. We still want them to be able to have commercial returns or have yields expected of the owners of that capital. But by the time you blend the capital from public sector, which is almost minimum in terms of the expected return, and the capital from private sector at commercial return rates, then we get to the point where we are getting as close to the single digit as we can. At the moment, we are expecting the MRIF to be around 12%. And as the macroeconomic environment improves and the interest rates come down, we expect that figure to begin to drop as well over time, to the extent that the need for government to continue to provide concessionary financing will continue to reduce, and private sector can take over that. And so our view as government is to catalyze that by bringing in that capital at very low interest rate, almost 1 or 2%. Because we know that once this sector is successful and we're able to build houses at scale, developers can confidently go out there and mobilize capital to build houses. People are able to own their own homes. The building material space expands and more businesses are successful. The biggest beneficiary of that will be government, because government will now have more taxes to collect in terms of company income tax. Government will be able to collect VAT, value-added taxes. And it also means that more jobs will be created. We estimate that about 12 jobs per home that will be built will be created. So take a rough example. It means that if you build 10,000 homes, that's 120,000 jobs being created. There are very few sectors where you can have that type of impact in terms of the number of things that are being created for the investment that will be made. And so for us, we're quite excited about this program, and it is our view that we'll work together, all the parties work together to make sure that we mobilize the capital at scale and begin to work towards bridging that gap. We're also not unmindful of the fact that the financing alone is not sufficient to bridge that gap. The other element that is important to bridge that gap is ensuring that we find ways to reduce the total cost of the housing cost. How much is it going to cost to build a 2 or 3 bedroom bungalow, for instance? We need to be able to reduce that from the amount that obtains today. And in addition to making sure we get cheap financing for developers, which is on the supply side, we need to think about what type of materials can we use, reduce the amount of materials that we have to import to do that. We see that as a next area of intervention that is needed in terms of finding ways to reduce the cost of building materials so that we can build houses at much lower cost and make them more affordable to our people.
Thank you very much, Dr. Takang. I think 3 things really stood out for me from what you said. First of all, the point about the public sector not being able to carry it alone. Interestingly, this year's federal budget is a budget of, upwards of 50 trillion, is proposing about 98 billion for housing and urban development, of which only 88 billion is for capital projects, which is just 0.18% of the total budget. So I think I definitely agree with you around the fact that this needs a partnership. But you also highlight the multiply effect of actually doing this strategic initiative, and of course the potential to invest in other parts of the ecosystem. But I guess my final question to you, sir, before you get off the line, is really around something you talked about, which is what's in it for investors. And can you talk to us a bit about the opportunities here for investors, institutional investors? Are there opportunities even on the retail end? Is this primarily focused on attracting pension funds? What's the strategy here from an investment perspective?
Thank you, Radke. There are We see investors as being in different buckets. Clearly, institutional investors, which will include pension funds. What is in it for them? One is clearly the fact that we expect them to get the returns or the yield on the investment that they would typically get from any investment that they do. Number 2, is the fact that we've created an instrument that allows the investments to be stored in an asset class that over time would only appreciate. Think about it. The world population, especially the Nigerian population, will continue to grow. But the amount of land available for constructing homes is fixed. Indeed, sometimes it's even getting smaller due to climate change and other factors. And so it is very clear that the underlying asset that these funds are going to be invested in, which is land, can only appreciate with time. And in most cases, the level of appreciation of that asset far exceeds the level of inflation. Today, most pension funds are investing, significant percentage of their portfolio is being invested in fixed asset, fixed income asset classes, whether it's T-bills, bonds, many of those. The yield on those are way below inflation, which invariably means that the amount of money they are putting in those investments is reduced in terms of its purchasing power, which is not good for our pensioners. So a lot of these pension fund administrators must begin to look for alternative asset classes to invest money for the pensioners, to invest in asset classes that will deliver returns that exceed inflation. They have a responsibility to do that. And this asset class provides them an opportunity to do so. What is the second category of investors that we see as being potential beneficiaries of this? You know, and many people in the room know, that the insurance sector in Nigeria is so shallow compared to anywhere else in the world, because we have not been deliberate and intentional about creating opportunities for that insurance sector. In the MLIF, each of those homes must have insurance against incidents such as fire and other forms of accidents, life insurance to make sure that peradventure the owner of the mortgage passes on, that insurance will be able to cover our risk. And so the second area is those investing in the insurance sector. We believe that this is a unique opportunity for them. The third set of investors are those who own construction companies, developers, those who are in the area of building materials. We strongly believe building more homes per year, way above what we're doing right now. We're creating tremendous opportunities for their businesses. They are more likely to sell more materials than they are selling right now in a very sustainable manner. They are more likely to, for the developers, they are more likely to have a captive market of takers, the projects that they are going to be engaging in, which means that the uncertainty of having off-takers is taken away, which also means that those who are going to be financing the development of those projects, such as commercial banks, the likes of Shelter Africa and other DFIs, who require off-take guarantees, are able to get the off-take guarantee from MLIF. And our view is that the collective of all of this makes this program a great tool and an opportunity for different set of investors.
Thank you very much, Dr. Armstrong Takang. You're already giving us some investment strategies here for 2025. We truly appreciate your time and your submissions. I think that was a very comprehensive start and context setting for the discussion ahead. So once again, we'd like to thank you for your time. And of course, the ARM team looks forward to strong execution on the real estate investment front. Thank you very much, sir, and have a nice day. Thank you.
Thank you, sir. Thank you, too. Thank you. Have a wonderful.
So you had it. That was Dr. Armstrong Takang, CEO of the Ministry of Finance Incorporated. Welcome again, ladies and gentlemen, if you're joining us. We're just getting into the throes of today's discussion. And to help us set the scene for the panel discussion that's to come, we'd like to invite again Fisayo Bassi, Head of Investments and Research at ARM, to present the National Sector Review. A warm round of applause for her as she comes. Thank you very much.
Thank you very much, Rolake. Good morning, everyone. Good morning, distinguished guests, ladies and gentlemen, and thank you for honoring our invitation and coming to our program of today. So I'm going to take us through what happened in the macroeconomic market last year, the macroeconomic environment and the financial market last year. And I'm also going to talk about our expectations for 2025. And at the panel session, the panelists will dig deeper into the opportunities that lie in specific sectors. So let's start with the domestic economy. So looking at the chart, we can see that the bars claret color represents the oil sector. We can see that the oil sector actually contracted in 2023. So that means that the growth was negative. However, starting from Q4 2023, we see that, there was positive growth, and that transcended into 2024, the first 3 quarters of 2024. And we can see that the growth actually touched around 10% in Q2 and around 5% in Q1 and Q3. But because the contribution of the oil sector to the GDP is small, that is why real GDP ended at 3.46%, supported mostly by the non-oil sector. So the non-oil sector, has ICT, it has services, it has agricultural sector, supporting the economy. And this subsector had actually been resilient in the past, since after COVID. So that has been what has been, supporting the growth in Nigeria. So what do we think will happen in 2025? So we came up with 3 cases. We have the base case, we have the bull case, and the bear case. So the base case is the one we think will most likely happen. And based on the base case, our estimate is that real GDP will grow by 4.13%. So this is not too far from CBN's projection of 4.16%. And this is based on crude oil production of 1.5 million barrels per day. And we've also seen some other things happen in the crude oil sector. So, for example, we have local investors showing interest and buying some of the assets from foreign investors. We also see increased investment, for example, from ExxonMobil, where they've promised to invest about $2.5 billion every year into their, offshore exploration. We also see some partnerships which promises to increase production volume. So our projection is actually based on this. We also see sustained growth from the non-oil sector. So, for example, the services sector, ICT, financial services, industrial sector, and agriculture. Now, looking at the bull case. So the bull case will happen if, for example, exchange rate goes to 1,000 naira to the US dollar, between 1,000 and 1,200, and inflation is really low at around 25% or 23%. So if that happens and, some other factors are also more favorable, then we could have growth of 4.25%. And if things become worse, exchange rate going to about 1,900 naira to the US dollars, which is the projection from some houses anyway, then we could have a base case of 3.75% year on year. So moving on to inflation. We all experienced this, right? A keg of 25 liters vegetable oil used to sell at around 30-something thousand naira, and as of last year, I think it actually touched 100,000 naira. So inflation rate started at 29.9% in January, and a lot of analysts projected that from July, base effect to kick in, where the kind of growth we saw last year will now reduce because we are starting from a high base the previous year. And we started to experience that everybody was happy. But however, from August, you see that it trended upwards again and ended at 34.8% at the end of the year. So what led to this? Food, the price of food did not reduce. It continued to increase. That was when we also saw the price of petrol increase, and it affected almost everything. So we also came up with 3 scenarios here. We have the base case, which is 27.26%. And if the base case scenario occurs, that means average inflation would have been 30.91% this year. And the bull case is more optimistic. So the bull case is 23.79%, with average inflation being at 25.93%. So that means things are favorable, exchange rate is low, and we do not have there is more food production, so we do not have the kind of very high prices we saw on food last year. And the bear case is the less optimistic option, where inflation may actually close at 36.89%. So that's been worse than what we have right now, and on average at 32.09%. So let's go to monetary policy. So some key events happened last year. Rates on Treasury bill, 1-year Treasury bill at the auction, early February was around 11%. And then all of a sudden it went to 19%, and market was like, what's going on? We knew what was going on because the CBN governor has said that, they were going to take their policy actions and the implementation more serious. But, like we used to have before, they would talk, then something else happens. But, it started to happen, right? So at the first MPC meeting, there was a 400 basis point increase. The market said, wow, this was a bazooka, right? So it's beginning to happen. And last year we had a total of 875 basis points. So that is 8.75 percentage points. And at the end of the year, we ended at 27.5%. Also to support that, as metric corridor was adjusted, CRR, I know the bankers here felt this a lot. CRR was increased to 50% for commercial banks and 16% for merchant banks, while liquidity ratio was left at 30%. Now, why? It's because of exchange rate volatility. So imagine starting at around 900 naira to the US dollars, and at the end of the year, we ended at around 1,500 with intervention. So you just imagine if all those things were not there, it would have been worse. So that was why, that happened. Another is inflationary pressure. I already talked about that. The next is money supply. You'll be surprised how much money we had in the system last year. You'll see the figures when we go to fixed income. And global disruptions. So many things are happening in the global economy that also had impacts on Nigeria. So what did CBN achieve with this? Liquidity management. It was very key to reduce inflation in the economy. Another was FX stabilization. In fact, I think they prioritized FX stabilization over, some other things. For example, growth in the economy, and it was really key that we had enough USD to support, the naira. So they had to prioritize that. And our external reserves grew and touched $40 billion in November, I think. Also, market confidence increased, not at the level we want it to be, but at least it's increased. So what do we expect this year? We expect a gradual deceleration in inflation, and this is irrespective of the rebasing of the inflation that MBS has announced. We still expect that inflation will trend downwards, whether it is base effect, whether it is the expectation of stable FX, or some of the policies, to improve transparency and efficiency in the FX market. We expect that inflation will decline. And the CBN may actually, in the first half of 2025, retain MPR at 27.5. Or, if they have to increase it, then we may see just a moderate increase of 25 basis points to 50 basis points. This is because it actually takes time to see the impact of MPR increase on the economy. So if they just keep increasing it, then it may get to a point where it starts to affect businesses, borrowing cost is too high and everything. So they need to see the impact and to hike rate, check the impact and hike accordingly. Okay, so now to fiscal policy. This is like the scorecard of the federal government. So let's see how they performed between January and August last year. So looking at federal revenue, they almost met the target, so it was short by 2.5%. Looking at all revenue, that was short by 25%. Why? Because production volumes were a bit impacted, although it was better than previous years. Non-oil revenue, which is what I spoke about, the services sector, the non-oil sector, they continued to support, GDP growth, and the revenue from that sector actually outperformed by 60%. the big elephant in the room, expenditure. Total expenditure did not meet the target. So that means they didn't spend as much as they wanted to. And this was short by 27%. Why? If you look at capital expenditure, I think they just had about 40% implementation rate. This is a bit critical for Nigeria because we actually need capital expenditure. We need development of infrastructure to support the economy. We need stable electricity and all that. And having a 40% is rather too low, and these numbers really need to increase. Now let's look at the last there, which is debt service. Last year they had to borrow a lot, and that's because they had to mop up liquidity from the system. And they did it at a very high rate that we haven't seen in a very long time in the market, right? So debt service increased massively by 34% beyond their target. So in total expenditure actually underperformed because of the weight of the capital expenditure, so by 27%. So looking at 2025 fiscal ambition, we believe that there will be full implementation of the recurrent expenditure and debt service. Of course, they have to service debt. If they don't pay coupons, you see clients calling in, hey, where's my coupon? So they have to take care of that, right? So that will happen. Then we expect around 30% implementation of capital expenditure, although we hope that this number increases so that, it could help to develop. Now, let's look at the numbers quickly. So revenue at 34.83 trillion plus funding. So the funding could be borrowing from our market, so treasury bills, bonds, and the likes. And it could also be getting funds from bilateral sources. So the combination of both will lead to a 47.9 trillion budget. Now, like I mentioned, more than 50 trillion, I know. That has not been approved yet, so let's just stick the one that was approved. But if it's approved, so they had mentioned that there will be focus on the agricultural sector, infrastructure. So hopefully that will help us to push up the capital expenditure. We hope that happens. So now looking at these key assumptions we have over there, a lot of them are quite optimistic. So oil price at 75, so our projection is 73, so not too far. Oil production at 2 million barrels per day. That's a bit optimistic in our opinion. If they achieve it, then, that would be very great. We would have more favorable macroeconomic environment. Exchange rate at 1,400. Ours is 1,590 to 1,600. So this is a little bit more optimistic, and we've heard the president actually mention 1,500. So inflation at 15.75%. I don't know how this is going to be achieved. So our projection for the best case was around 27%. If we achieve 15%, that would be super great, right? We shall see. The all GDP at 36.7 billion naira. I know that this is on the back of the production volume of 2 million barrels per day. So it is also optimistic in our opinion. And GDP growth rates of 4.6%, not too far from my estimate. It's close to our best case, So that means if these things could happen, then yes, we'll be having a best case scenario. Okay. Now let's go to capital importation. Okay, so apologies, we had the year there. So the first quarter is the first set of 4 quarters is actually 2022, the next 2023, and the last 2 represent 2024. So as you can see, between 2022 and 3, there was a decline, and we all know why, right? Different measures to restrict capital from leaving the economy. And of course, foreign investors were not happy, so they were not bringing in more capital. And something happened Q1 last year. I had mentioned some of it. The NPR increase, you'll be wondering what was the impact of this. So you could see the impact. Can you see the jump there? And the claret color is actually foreign portfolio investment. So the foreign portfolio investment means that foreign investors came in and invested in our capital markets. So that was where most of the monies came into. Although by Q2, some of them left. I mean, they did an in and out and gamed us somehow. They left. However, storms still remained, and that led to what we had in Q2. So we had better numbers in Q2, meaning that the economy was, the environment was more supportive for foreign investors. Okay, so there is a yellow bar there. That is foreign direct investment. I know we've been hearing different companies leaving the economy because things are not favorable for them, and maybe Nigerian revenue from Nigerian market is too small. By the time they convert it to USD, blah blah blah. So that is where we had almost nothing in Q2, really small. So that's the risk to the outlook. Let's look at currency. So at the start of the year, official rate was around 914 naira to the US dollar. And parallel market rate was around 1,180 to the US dollar. And you could see the gap between the two at the start of the chart. However, when these policies, came in and they increased MPR, they were able to get more foreign inflows. What happened? The gap closed. That's one. And we saw the official rate actually, rise above the parallel market rate. So that means that Naira was actually trading at a much higher level than official market. And then this fluctuated all through. So you can see the fluctuation around May. You can see a decline. So that means, when you see a decline, that's appreciation. So the Naira appreciated. So around May, you could see Naira appreciation. Why? Because of, the impact of these policies actually coming in. But what happened afterwards? We saw a gradual increase and the reduction between the two rates. And we did not see much volatility as we saw in 2023 and early 2024. And at the end of the year, they came up with the EFEMS. I know that a lot of us have heard about it, the electronic foreign exchange matching system. So because of that policy, which will help to increase or to improve the efficiency in the market, because of that, you will see an appreciation. So the Naira appreciated both at the foreign market, the parallel market and the official market. So what do we expect in 2025? We expect that the external reserves will be buoyant. We already saw that happening last year, although by the time I checked the numbers, it was already down below 40, and I'm like, oops, we are down again, but hopefully, because of the borrowing this year, that would also help to boost the external reserves. Also, we expect slightly higher FPI. We would have said significant, but, Trump policies. Okay, so Trump policies, foreign investors may be scared. They want to go for safe assets, so, we kept it moderate. So slight increase in the foreign portfolio investments and less demand pressure on the Naira. I think that is very important for Nigeria, to have less demand pressure, to have less speculatory activities, and a rather stable currency. If that happens, then people can plan and, grow their businesses. People that need to import can easily do that without fear of losing on just, converting currencies. So our estimate is actually 1,590 to 1,600 Naira to the US dollar by the end of the year. So now let's go to the capital market. Last year, the oil and gas sector performed really well. You can imagine 160% in just 1 year. That's super. Like, no fixed income investment would even give this kind of return. So these are the kind of superior returns we see in equities. If you can just, have the patience to invest and wait, and also diversify your investment, then you can achieve something like this. So the oil and gas sector, grew by 160%, and the previous year it returned 125%. So combine both of them, that's actually quite massive. The insurance sector also rallied. Why? Because of the insurance sector reform that was approved by the Senate towards the end of last year. So we saw some stocks that have not moved in so many years actually start to rally. And then, portfolios were growing, particularly people that just said, just leave my insurance stocks there, don't touch it. And then they were actually able to reap nice, growth last year and early this year. The consumer goods sector performed fairly well to 54%. However, they were impacted by the high inflation and exchange rate. The banking sector that did so well in 2023 underperformed. Why? Because the CBN announced recapitalization exercise. So that led to sell-off in the banking sector. And, we're expecting that it was going to rally, and it just did not, give us that return last year. So that was why the banking sector did not perform so well, but it still did positive. So looking at the broad market, industrial goods sector was also, I have to mention that because Dangote Cement was much liquid for the best of last year. So people that had it and were trying to get out, they just put their beats in the market and nothing was happening. That was a bit sad, but. So looking at the broad market, which are the two indices you see there, the All-Share Index and NGX 30 actually performed around 37%. So this year we're actually, optimistic about the market, positive corporate earnings. If interest rate declines, then we'll see more activities in the equities market. People like dividends. So yes, dividends, stable exchange rates, more domestic investors' participation in the market. That's what we've seen in the past maybe 3-4 years now. And positive outlook in the sectors, oil and gas, industrial goods, consumer goods, insurance and banking sector. And we could see some interesting IPOs, like some companies coming to list on the exchange, particularly the oil and gas sector. So in the fixed income market, we all knew what happened. Yields were really high. It rose actually massively to the levels we haven't seen. Treasury bill yield was almost touching 30%. And bond yields, in fact, we placed a bet in my unit that it will not touch 22%, and it touched 22%, so we lost the bet against the CIO. So real estate performance in 2023 was actually a lot better, but last year they were impacted by the high inflation rate and the high exchange rate because of the, construction materials that are usually imported. So we saw that performance was quite low, but construction particularly recovered in Q3. Okay, so I'll just quickly speak to this. So what is our outlook in the fixed income market? In H1 this year alone, we expect 17 trillion liquidity in the market. That is massive. So that gives context to the liquidity last year that was mopped up. So some of these liquidities are maturities and coupons that we due in H1. And that means the CBN is expected to conduct liquidity control to mop up the liquidity. So our recommendation is, because we expect that yield may trend downwards moderately, investors can, increase the maturity of their fixed income instruments, so especially short term. So if you're buying treasury bills, try and buy the long term treasury bills. Commercial paper, try and buy the long term, so you can lock in yields, and until your investment matures, the yield is not going to change. Your return is not going to change. And then if you invested in bonds maybe last year at the high level, and the yields on bonds trend downwards, that could give you an opportunity to make some capital gains. So by the time you check the value of the bond, when yields decline, you will see that it is higher than where you bought it. So if you are playing short term, you could actually sell. Otherwise, you can just continue to hold it to maturity. So for real estate, you could participate directly or indirectly. So directly is investing in direct infrastructure, utility, commercial assets, residential properties for rental purpose. Or you could invest through private equity funds, investment trust, MREIF, we need funds, And there's some other funds dedicated to real estate and infrastructure. So in the equities market, we're actually positive on these sectors, and these are like largely all the sectors, but at varying levels. So oil and gas, we are quite bullish there. Telecoms, yes. I mean, you see that MTN got approval for 50% tariff, so that is going to help their numbers, even though they have, huge debts that they are trying to pay off. But analysts have said that, this is going to help the numbers and help them to return positive. MTN already released, so when they released their results last year, I think it was their Q3 results, we saw that, they actually had positive net income. So we believe that this could increase. Consumer goods sector, a stable FX, backward integration will help them. Banking sector, because interest rate is high, so when they give out loans, they earn more. If they buy financial assets, they earn more, so that would help them. In the insurance sector, because of the recapitalization exercise, we may start to see some mergers, acquisition, and so we believe that this will help them to be able to write, write bigger volumes of transactions. So this would actually help to build that sector and increase the returns of the players in the sector. While for industrial goods sector, we believe that if the federal government is able to stay true to the capital expenditure that they had promised, and hopefully they achieve more than 30% implementation, then this will help the industrial goods sector, because it's some of their produce that are used for these activities. Thank you very much, everyone, for listening.
Thank you very much, Fisayo Bassi, Head of Investments and Research at ARM. Another round of applause for her. Thank you for your simple, straightforward, and plain-speaking delivery, laced with a bit of humor. Thank you so much. So Fisayo has set the context very nicely for us. We're now going to move straight into the panel discussion, and I'll invite the panelists to go up. First of all, I'd like to call Dr. Biodun Adedipe, Associate. He brings a wealth of experience, economic analysis, and development strategies. So good to see you. We know you're very busy, so it's a real honor to have you. If you please move to the middle, the next seat. I'd also like to invite Muni Buba, Executive Director of ARM Investment Managers. Please give him a round of applause. He will offer some valuable insights into the financial markets and more on investment strategies. And of course, last but by no means least, my sister and friend, Rachel Morosha, CEO of ARM Harris Infrastructure Manager. Her expertise in infrastructure investments will guide us through Nigeria's potential in this sector. Right at the end, or in the middle. Yes, that's fine. Thank you very much. So please, if you're online or in the room, you can get questions ready, because we'll have time to take some questions just as soon as we're done. Thank you very much. So great. We're going to spend the next 30 odd minutes and a bit to sort of talk through some of the key things that have already been highlighted before. And having listened to Armstrong set the context around opportunities in infrastructure, I'd like to start first with Dr. Adedipe. There was a lot that was said in Fisayo's presentation. The targets around inflation, the president wants us to bring it down to 15% by the end of the year. But I also want us to put it in the context of the global economic environment. You know, there's a famous saying, you heard it, when America sneezes, the rest of the world catches a cold. And Nigeria is certainly by no means immune. You hear a lot about tariffs, trade wars. What impact will all of those things have on Nigeria's oil exports and non-oil exports? Can you help us paint that global picture to start with?
All right, thank you so very much, and I'm happy to be here as part of this conversation. Now, when Trump was campaigning, he made a promise that he was going to slam tariffs on everybody. But he especially made reference to China, Germany, then Canada in particular. But he now gave also an indication that for China, it would do up to 60%, and then for the rest of us, between 10 and 20%. So what I told myself then was, number one, what would this likely do to global trade? So now, if you slam tariffs on others, they won't fold their arms. They will also retaliate, which we have already seen happening. And when that happens, that means there will be a dampening of global trade to start with. So if global trade reduces, how will that also affect global GDP? There's also going to be a dampening there. But in addition, there will be the supply chain disruptions. And all of these will also come together, and then you sit back and say, how will this affect the US economy? Just like you said. Now, number one, if tariffs are raised, it means imports into the US become more expensive. So inflation rate in the US will go up. Then we see a replay of the scenario in 2022, what we call the normalization, which means the Fed will respond to the inflation uptick by raising policy rates. If the Fed does that, then it comes back to all of us around the globe. And in fact, I will use the example of Japan. In 2022, Japan lost $60 billion to the US financial markets at the beginning of normalization. And so if most international investors look at that scenario, as dollar assets become more attractive because of the uptick in the rate, the policy rate, how will that play out against investors here in Nigeria? All right? So dollar assets more attractive, some of them will want to look in that direction. All right? But it doesn't end there. We can now bring back the other components of what Trump promised, which relates to the oil sector. He made a remark, I think about 2 weeks ago. He said, as far as it's concerned, drill, baby drill. Okay, that means produce hydrocarbons.
Like she said, close to the end of the year, this news came out, and we literally saw the insurance sectors increase by times 5, 6, 7, some of them. I mean, so this is very good. We know that the insurance penetration in Nigeria is extremely low, not even 1%. So this will enhance their capacity in terms of underwriting. So that's positive. On the fintech will continue to play their role. I mean, on the digital space, mobile technology, AI, or financial inclusion, especially on the rural side. We know also, of course, there are growing interest for non-interest finance, sustainable finance. All in all, obviously, our regulator will continue to do his work. I mean, CBN, as I said, the leadership of CBN since they came they took charge, they have taken quite strong measures. So we think also that they will continue, especially on the, let's say, compliance side, money laundering. They will continue their strict control to be sure that all the actors are compliant. So, I mean, in conclusion, we think that the financial sector is strong, way stronger than it was before, and will be able to compete on a global landscape. I mean, and we are seeing more and more of Nigerian banks opening offices in Africa or in Europe. So, I mean, yeah.
Thank you very much. A round of applause for Monibo. I think there's a lot of optimism, and it's good to see that the consolidation train is sort of moving to other sectors as well, like insurance. Who knows what sector will be next? So thanks for that expose. So Rachel, I'm going to come to you. I mean, a lot has been said about infrastructure, but I have to say that I'm only cautiously optimistic for several reasons. When we listened to Dr. Take earlier, talked about what I would sort of class as maybe the 3 L's: long-term, local currency, and low interest. That's what we need for long-term infrastructure funding. We're seeing the initiatives like the Real Estate Investment Fund, but broadly across the economy, you saw FISAI present the budget there. What sort of reforms do you think will be absolutely critical this year to unlock private sector investment in infrastructure, given the journey so far?
So good morning again, everyone. Thank you, Rolake, for that question, and I think you've been on this journey as well with many of the stakeholders in the infrastructure sector. I just want to start by saying that around the world, infrastructure is one of the lowest risk asset class. However, it hasn't been the case in Nigeria and frankly around the region. And it hasn't been the case because investors who are attracted to that asset class like the predictability of the cash flows that are coming from those projects. We haven't been able to deliver that. I think we've done that on an ad hoc basis, which really demonstrate the lack of coordination both on the regulatory side as well as on the sort of macro policy, particularly when it comes to monetary policies, including close collaboration with the private sector to really establish a framework that works. It's been tried, and I think we have very good reforms and policies on paper. The execution of it has been what's fundamentally lacking. So in terms, before we even go into what needs to be done, because I think we've been saying for decades what needs to be done, I think we need to really focus on the collaboration, and I like what the CEO of MOFI was saying earlier, with the, between the private and the public sector. I've seen many investments, and I'm going to go into the lack of financing, but I think even before we go there, the big roadblock is truly that execution framework. Because I've seen many projects whereby the financing was locked, the government had one vision, the regulator had another, investors had a completely different vision, and it never came to life. We've missed so many opportunities because of that. So collaboration, not just at the policy level, but also at the enabling investment, essentially, by understanding what are those investors that we targeting looking for. So mainly it's de-risking, and policies and regulation is one thing, but you also have at the project level, and we've seen that particularly with the power sector, when you do not have bankable, if I can say, offtakes that allow to do the projects that we need. We have such a big energy gap, power gap in particular, but we are unable, we've been unable for over a decade to do that at scale. We had to, and it's great because the market has evolved, so we're now doing it off-grid, decentralized, but with the need, and I think we have about 6 gigawatts of latent demand. If we continue to put electricity at a pace of 1 megawatt a bit, we will still be there for a long time. So we have to go back to be able to do it at scale, and for that it would require the collaboration. So the other bit on the local financing piece is traditionally the majority of projects that we've seen come to life have had essentially US dollars as the currency of the funding, when we do know that the revenues are collected in local currency. It has put unbelievable pressure on the performance and sustainabilities of those assets. Tapping into the local currency market means that, especially on infrastructure, you need to be able to attract local pension funds. They have the best profile, too much interest in those assets, and we haven't been able to do that effectively. We have, but not as much as we need because of the risk perception and the uncertainty when it comes to delivery of performance over a long period of time. At ARM Harris, we were the first to be able to attract local pension funds into the capital structure. So what allows that to do, what that allows you to do is to be able to better match your assets and liability at the project level, fundamentally decreasing and mitigating the local currency risk. In addition, when we do when we finance project, we use project finance. What that means is that you have to push the risk outside, you have to insulate the project, and push the risk to pockets of stakeholders within the project that are best able to take on that risk. Traditionally, FX risk has been taken and borne by a government offtakes or other stakeholders that are in the private sector, in the public sector. And the ability now to continue to do that, and I was mentioning the decentralization now of projects, means that we have shied away, or at least haven't been able to really bring large-scale projects on grid, moved into bilateral arrangements with between private entities, and we've been able to negotiate those tariffs with escalation clauses that still allow us to sort of mitigate the local currency risk in that manner.
Yeah, thank you very much. A round of applause for Rachel. I think, you know, the interesting thing is ARM itself is actually a pioneer in infrastructure development, and there are models that have been tried and tested along the lines of some of these structures that you mentioned, which I think we could do well to bring back. So thanks for taking us through the ways to think about de-risking these projects and also attracting funding. I'd like to come back to you, Dr. Adedipe. As a Nigerian, I often like to put myself in the shoes of the ordinary Nigerian who maybe thinks that they're a street economist and is trying to make sense of some of these trends. So I want to talk about the consumer price index and inflation, but I want to draw your mind to three things. It appears to the ordinary Nigerian that each time we sort of reach there seems to be a restructuring of the fundamental basics of what we understand. And I'll give you an example. So inflation reached what some people call multi-generational high, almost a 30-year high in December. Now we're restructuring the consumer price basket. At one point, Nigeria lost its ranks in the GDP rating. Now we're rebasing. There was a time, I think about 18 months ago, where unemployment was at, 30-something%. Then we recalibrated. So my question is, are we really treating fundamentally the underlying causes? So if we look at inflation, we often talk about cost plus inflation, just trying to window dress the symptoms. So help us understand the CPI recalibration a bit better. Thank you.
All right, thank you so very much. Very good question. Now, currently we are discussing rebasing of the consumer price index. Yes. What that means essentially is we take a fresh look at the basket of commodities that the average and regular Nigeria consumes on a daily basis. Then we ask ourselves, what should be the weight assigned to each item in there? And that comes from the perspective of how much do I earn in a month? And what do I spend the money on? If currently I spend a greater percentage of my earnings on food, that means the weight assigned to food should become higher than what it was traditionally. That's number one. Then secondly, if you look back 5 years ago, or let me say 6 years ago, 2019, and compare that with 2009, certainly the basket has changed in terms of content.
What would you say has been the biggest change in that basket?
Essentially 3 items. Okay. Food, then transportation, and energy. Now, if you look at what it was some 16 years ago, it's not exactly the same as it was 6 years ago, and of course today. So rebasing CPI simply is to say, look, let's come to a closer period and adopt that as the base. So if we come to 2019, for example, and adopt that year as the new base, by all means, the rate of inflation will drop. And most likely, we need the range that Mr. President mentioned, 15%. Now, I will say we should not clap our hands on that yet, because our story will not be any different than what has happened to Pakistan and Bangladesh, where inflation rate came down, but the actual cost of living still remained very high. So we must also understand the difference between what you pay for what you consume and what inflation rate is. Inflation rate simply talks about the rate of increase in the general price level, which means prices are still increasing, but the rate of increase has reduced. So that's what professional economists like me, we clap about. Our inflation rate has dropped. it doesn't mean the price of what you consume has actually dropped. So that brings me to the key question, the key component of inflation, and that is, what is the nature of inflation in Nigeria? It is mostly structural. And so what that means then is that it cannot be effectively addressed by the focus of the Central Bank of Nigeria, which is increasing the monetary policy, maybe 50%. And that's estimated at 3.4 trillion naira that we lose every year. That's 50% of harvest in Nigeria. So imagine what we can achieve if we find a way of storing and also processing. So that will affect food inflation, which is the major driver of the inflation you and I experience today. The second one there is what I call energy deficit, which of course was just spoken to here. And the third is manufacturing deficit, where in fact we don't produce most of what we consume. Incidentally, that also connects to Trumponomics, as I like to call it. Okay, that's my coinage for Trump's. Because what Trump has done by his policies is to make everybody go in the direction of protectionism, and that means look now inwards. Which, interestingly, that is what he's trying to do for America anyway. All right. So it means it's a time we must look inwards. But the food we focus on in agriculture is not about producing raw materials for the metropolis. That has to be about producing food that we consume. That will deal with inflation. Now on GDP, that's the other.
No, I mean the question was on inflation. I think I brought up the GDP and the unemployment just as examples, but yes, I think you touched on the bottom line, which is around the structural causes of inflation, and that needs to be beyond monetary policy. So I'm going to come back to you, Muni. You know, when you're looking at your investment strategy, even just say as a retail investor, one of the things people often tell you is inflation is obviously a big driver because it affects the real returns you get on whatever assets or instruments you're investing in. So looking at all the current macroeconomic factors, inflation, interest rates, we talked about the stock markets, Visaya talked about fixed income and yields on that. Where should we be positioning in terms of the asset classes for 2025? And can you then comment on the stock market, perhaps, as a focal strategy in the portfolio of an average investor? What's your thinking around that, at least for 2025?
Okay. Since it's a discussion, let me start with rebounding on something that Dr. Abiodun just said, food inflation. Because it's really the big elephant in the room. It's the main driver. It has reached 40%. So at ARM, of course, our job is to create wealth, provide return, but also to find solution for Nigeria, long-lasting solutions. So Rachel, as CEO of Infrastructure Fund, provides some solution. Earlier, Dr. Takan talked about the collaboration ARM as a fund manager has been working for many months with the Ministry of Finance Incorporated to find also a lasting solution on the housing sector. Now coming into food, in fact, yesterday we were in Abuja with the regulator because we are launching a fund, a food fund, which will also target the challenges that Dr. Abiodun just pointed out. So basically, we are launching a fund very soon, in the next probably 2 months or 3 months, that will address input production, because we use way less fertilizer, for example, that emerging countries, like, for example, China. We use something like 10 kilo per hectare fertilizer in Nigeria, while in Southeast Asia is 5 times more. The processing side, we process less than 10% of our food. So basically, we are not exporting. Okay. And what he mentioned, the harvest, we are losing 50%. We'll be also investing in the distribution side. We know we have serious issues around logistic, infrastructure, cold chain logistic, basically. So we are launching a fund that will be targeting those specific area. Now, coming into inflation and where to invest, obviously we know what is the effect of inflation on one's saving or one's wealth. Again, we think that we have developed a wide range of alternative funds that should provide you return that goes beyond the classic non-risky asset classes. So being infrastructure, being agriculture, we are working on some private debt solution, trade finance, and so on. So investors should look at those opportunities. Going back to classic investment, the equity, for example, I will refer to a presentation from FISAIO, but which was a compilation of the research team. On the equity side, we are very positive on oil and gas, on the banking sector. We think because we are optimistic on inflation and FX, we think that people could look at some value stocks like consumer goods or industrial goods. Nestle, for example, was a clear good call for us. Some stocks that have been, have experienced challenges over the past 2 years because of FX liabilities they are carrying. The MTN, Dangote Sugar, Nestle. In case the inflation slowed down, in case FX stabilize basically on the back of all the reforms, all those stocks basically will, their multiple will automatically improve. So we are positive on those. There are some opportunities probably on the listing side. On the fixed income side, I will say very quickly, because we expect inflation to come down, rates to come down, investors should increase their duration. Investing at 20-21% maybe is once in a lifetime opportunity. So this should be captured.
Yeah, thank you for that. I guess the underlying message is maybe a sort of mixed or balanced approach to looking at some of these investments to protect your position would also be key. We're just coming to the end of the panel session, and Rachel, I'll come to you for the final question. I'd like to encourage everybody to please have their questions ready so we can take some. Rachel, I wanted us to shift to something that I think is very closely tied to some of the references around agriculture. You heard about cold storage. Transportation and logistics, ports, airports, aviation, all of those things are so key to both global and local trade. Given the fundamental requirements of the economy, what opportunities are you seeing for infrastructure development and investment in that kind of hardcore infrastructure, transportation, logistics, and how do you think that sector will evolve over the next year?
So thank you. So in terms of opportunities, I think even before we go to all these other sectors, energy still remains, and access to electricity still remains the backbone of any economy. And so it is still the biggest opportunity that I do see. It's one of the most resilient sector because we just cannot do without it. And in spite of some of the challenges within the value chain, as private sector, we've been able to find those opportunities that really brings the right kind of capital at the right stage of the project and able to deliver, stable cash flows and solid returns for foreseeable future. So in terms of investment, it is still the number one on the list. With that now, what can we do? Of course, we need to be able to also manufacture. Once we have electricity, we can do that at scale. And we need to be able to move those produce from point A to B in an efficient way. And that's what transport comes. However, and I think that's why everybody in the room could attest to the scarcity of transport projects, generally speaking. It's been very challenging. ARM was able to do the Lekki toll road. We haven't seen sort of large toll road projects in that manner for a while. At the port level, we all know our ports are congested. We haven't been able to sort of solve for that. And the reason is that transport is very different than power. Power, you are able to enter into contracts where you secure a minimum offtake, right? So the purchaser would guarantee you a minimum level of revenue, which you then can serve either the debt or deliver dividends to the equity providers. In transport, it is more challenging. You do not have, or you are not forced to be able to pass through that road or utilize that port. And in terms of guaranteeing, and I mentioned that investors, particularly coming to the infrastructure asset class, do come because they like the stability and predictability of the cash flows. So when this cannot be done, right, because you do not have a minimum offtake, generally speaking, that's when the government PPP model. And because when we've seen the fiscal, we're talking about the high level of debt, etc., it has been to supporting those projects in that manner and providing comfort back once they provide. I would say it's on the way. And it would really depend on the commitment from the various government entities, either at federal level or state level, to really provide investors with that confidence should the revenue model not be solid enough. Lastly, we talked about ICT. We all consume a lot of data, and we will continue to need it. AI or digitization continue to be major drivers, and Nigeria has put itself on the map with several companies that are now global, have been acquired, or definitely on the radar of the global community. So I do foresee we will continue to see that, and it goes across all the sectors from energy, transport, manufacturing, because it does improve productivity, and it also enable us to be able to leapfrog in producing more efficiently, providing higher yield, regardless of the industry. And for that, we, again, need electricity. So I would say electricity, and then the rest will come.
Okay, thank you. So it all boils down to electricity and power at the end of the day. Thank you very much. There are quite a few topics we haven't touched on, but just so that you can park them whilst we go to the audience, I'd like to maybe get your thoughts at some point on the tax reform bill, because it will have wider repercussions across so many different sectors, and then maybe get some thoughts on what we can do to attract FX inflows into the market in Nigeria. And also, maybe Rachel, also for you to think more broadly around foreign direct investment in Nigeria and what you think can be done, especially around incentives and those things that will attract investment into the country. So, distinguished ladies and gentlemen, would like to take some questions now. Please keep your questions very concise. Do let us know who you are, your affiliation, and we'll probably take maybe groups of 3 questions. So who would like to go first? I believe our ushers have mics. I see a gentleman in front, another gentleman there in the middle. Okay, so the 2 gentlemen on this table, and we'll take the 3rd gentleman in the back there.
Do you mind if I sit down?
Yes, sure.
My name is Godwin Itama. I have an oil and gas background, but currently a farmer. And my question is around the supply chain in the agric industry. What I've seen is, from my experience, is disjointed, and it's also a huge amount of loss. So where are the opportunities to invest in the supply chain side, where a one-stop shop kind of will help the supply and the demand side of agri products, including the support structures of technicians and products and machinery maintenance, because these are issues that actually shut down productivity in the agri industry, speaking from my experience.
Thank you very much. Can we have the gentleman there, please?
Thank you very much. I like Dr. Adedipe's comments on the exchange rate projected by the federal government. Thank you.
Okay, thank you. I will take one more. I think we had someone else on the table in front here. Yeah, we'll come to you for the next round of questions. Can you give the mic to this gentleman, please? Oh, you were spotting. Okay, let's go to the back then. Thank you.
Good morning. My name is Ndidi Okeke. I want to ask what ARM's outlook for 2025 is around the carbon markets and green funds.
Okay, thank you very much. So the first question was around supply chain and an agri one-stop shop all around, essentially an ecosystem structure for agribusiness in Nigeria. Who would like to take that? You don't have to be on stage. Would you like to give the question to somebody?
We are a team. Basically, let me introduce you the CEO of, the MD of ARM Agribusiness. He will take a question.
Thank you, Monia. So my name is Wilfried Korsaga, so I'm heading the ARM Agribusiness Fund. So basically, I think what you mentioned is one of the challenges that we see in the value chain, but you have other challenges because basically you have a lot of leakages in the value chain from the farm all the way to the fork. So this is what we're trying to cover. So we understand where are the leakages, we understand where are the challenges, and we're trying to address, I would say, the different challenges. If you take, for instance, food production. So you have three areas in the value chain that we need to cover: food production, food processing, and then food distribution. Those are the three key areas. Because unfortunately, we've been focusing, or most African countries, we've been focusing on the production, but more on the farmlands. I think this is where you are. But on the farmlands, you have a lot of challenges. You have Mother Nature. You are dependent on the nature. Most of the time, you have too much water. You don't have, so much water. You have to rely, as you mentioned, on the staff. So you have issues in terms of, agronomic practices. You have issues around, their technical abilities, capacity buildings. So those are things, there's nothing you can do, if you don't have the financing, because you have to do an arbitrage of the limited financing that you have. Either you invest in crop preparation, you use fertilizers. We have very low mechanization, in Nigeria per se, which I would say in Africa is like 1/5 of what we see even in Egypt in terms of mechanization. So that leads to low yield, low production. So there's a lot, unfortunately, we can't do into that space because we need government support, and the government is supporting the farmers. A lot of farmers are not aware of those supports. So this is also where the challenge is coming. They need to make sure that they can have access to those financing. So what we're trying to focus at ARM is to make sure that we optimize the value chain. So we'll be supporting businesses that will invest in food production. We'll make sure they will have access to the fertilizers. They will increase the mechanization to make sure that the yields will be higher. So the food level will increase, and by definition, we will try to decrease the growth of the inflation. So this is really the key part. I think the doctor mentioned also the issue in terms of the wastage, all about 50%. So we need to be able to process what we are producing. We are exporting 90% of our crops. So there's a lot of value that we can actually extract from this. And the last point is also related to infrastructure. We have to make sure that we have the warehouses, cold chain, to make sure that we can store our food, and also to actually reply to market demands. So those are things that we are really focusing on, and we hope in the couple of months to raise a food fund. We hope that we'll, in terms of range, we are thinking about $100 million. It's not enough, but at least we want to address the elephant in the room and hope we can catalyze, as much capital as we can to tackle this.
Thank you very much for that response. I think this also warrants further engagement on the formal session. Dr. Adedipe, your comment on the Nigeria's exchange rate outlook, please.
Thank you very much. Now, we have seen in the budget for this year an assumption of 1,400 naira to the USD. And also in one of the remarks of Mr. President recently, what we call in FX economics, significant utterances of top government functionaries. And he said he's expecting the naira to settle at around 1,500 naira to the dollar. Now, from our own expectations in terms of outlook for the naira exchange rate, Visa growth rate of the GDP this year. In BA Consult, our own estimate is 4.12. So when I heard Fisal say 4.13, I said, look, it appears we are in the same direction. Now, coming to FX, our own outlook is 1564.4, which again falls in the range that Fisal mentioned. And our reason is very simple. If we expect the economy to grow by 4.12%, we expect inflation. These sectors already highlighted is the 39.1 products that we needed dollars for will no longer be needed. So that will reduce the pressure on demand. So and that is how we arrived at our own expectation of 1564.
Thank you very much for that. Nigeria has a target of 2.06 million barrels. Do you see that also, or at least a target, an objective that's close to that, helping to provide some FX inflows, or are you not relying too heavily on that as an avenue?
Yes. 2.06 million barrels per day for me is not too optimistic. Okay. Why is that so? Now, in the last 14 months, the production of crude oil in Nigeria has been increasing gradually. And of course, the latest we had in December was 1.48 million barrels per day, which means if we continue at that rate, there's a likelihood of making that assumption in the budget, or at least not too far from it. That's on the one side. Now, in the last 33 years, and I'm specific now, we have had allocation for domestic consumption at 450,000 barrels per day. Okay. If you check out the data, it has been a constant. So which means if you back that out from our production figure, that is what is available for export. But what is available for export also, some of it has been mortgaged by the previous administration, and we know that for loans. So which means the only way out for Nigeria is to produce more of crude oil. Okay. And that is what I see this current government is doing. So if we do that, then we have also a positive impact of that on our foreign reserves.
Okay. Thank you very much for this perspective. So Rachel, you know, we're talking about increasing crude oil production capacity, but there was a question around carbon markets. So we have a net zero ambition. What is the outlook for that market? Nigeria has a 2060 net zero ambition. Companies, private companies also have net zero ambitions. I don't know if ARM has one in terms of its own carbon footprint. But can you help us sort of make sense of what the opportunity in the carbon market is?
Yeah, thank you for that question. I think it's evolving, and everybody is looking at it very cautiously. There were attempts previously, so this is not the first time, where there's an attempt to have a market where CO2 emission, like CO2 certificates, essentially would be traded and used, in the financial market. It hasn't worked in the past. I'm not going to go into the details, but I think that for it to work, and we go back again, I think we know what to do, generally speaking. The issue, again, is to be able to implement it in a manner that is harmonized and make sense. That's the biggest challenge, because collaboration, as much as we think that it's easy to sit on the table and talk, it has been our biggest challenge, even here in the various sectors that we operate in. If I may, I just want to conclude with one thing is, you had the question on FDI, and I think it's important. Dr. Adedipe was saying earlier that we need to start looking inward, and we do. It is no longer the times where capital is abundant, foreign capital is abundant. I can tell the crowd here that we have severe competition from other places globally, Southeast Asia in particular, that offers similar opportunities that Africa, offers today. And investors, or foreign investors, are tired of our slow pace, essentially, of implementing what we know what to do. Because I mentioned earlier, we have some of the best reforms and policies in the world, so nobody outside can tell us what to do. We know what to do. We are just not doing it well enough so that we can operate at scale. We've done investments within the group, but we're doing it in spite of all these challenges that we've all mentioned again today. That prevents us from working and operating at scale. So my $30 million investment that I can do by having insulated all the macro risk and all the risk, it's a $500 to $1 billion investment in Southeast Asia. How can I compete in that market? But it's actually a good thing, because looking inward, again, we talked about local pension funds, we talked about capital markets. We will find creative ways to continue to resolve our issues. I think we need to accelerate. I think we need to work at scale. And the only way we can do that is by having the government supporting private sector to do it at scale.
Okay, thank you very much. And Muni, I'd like you, maybe when we come back from the final round of 3 questions, to talk a bit about foreign portfolio inflows. Because most people argue that at some point that should become so insignificant to FX stability in the country, because we're more focused on addressing all these more fundamental structural issues. So maybe some commentary around FPI inflows into the stock market. But when we come back from the next round of questions, I just wanted to add to the point around the carbon markets that last year, African governments came together to set up the ACMI, the African Carbon Markets Initiative, and that's something that, to the question that was asked, could potentially put a bit more structure around helping companies and governments tap into the carbon system. So we'll take a final round of 3 questions, because we want to do a hard stop at 11:30 a.m. So please keep your questions short. Let's see your hands come up if you do have questions. Yeah, I see a hand right in the back there.
Okay, my name is Alaji Dayo. I am from a manufacturing company. So the question I want to ask is the opportunities.
Opportunities in
the manufacturing sector.
Okay.
If you look at that sector nowadays, especially what we have seen, the FX is one of the issues. Raising FX because of the volume of the FX, even the banking sector cannot support. You have to go through the third party. Also look at import duty rate. A lot of things affecting that sector. So what are the opportunities for these sectors?
Okay, thank you very much. The next question, please.
Yeah, good morning, thank you. Abiola is my name. Now, are you prevented from trading in cryptocurrency? And if not, what are you doing towards engaging in such? And there are several types of crypto investments and the valuation from different companies, Bitcoin and so on and so forth. Is ARM prevented from creating their own? And if not, when are you going to start? Secondly,
very quickly, sir, please.
Yeah. Oil production is not the only source of foreign exchange that we can make. Mining is there, but it seems the government is not so serious about focusing on mining of gold, lithium, and so on and so forth, to cap it and know the exact amount that they can realize yearly in hard currency. Thank you.
Thank you. One more question, please. There's a gentleman right in front, first table. Can we get a closer mic to him, please? Perhaps, sir, you would. Yeah, please go ahead. Okay, just hang on a second.
I'm Latif Akinpelu, Center for Petroleum Energy Economics and Law, University of Ibadan. You mentioned infrastructure development, and I was glad when you also said sustainability of that infrastructure. I wonder if what you mean is the maintenance of that infrastructure on a long-term basis. Because what's the use of building a multi-billion-dollar infrastructure and you see it crumbling before our very eyes in 1 or 2 years? To me, in that depreciation of the infrastructure is like post-harvest losses in agriculture. So that's a low-hanging fruit. And how can we capture the real value of that infrastructure development through ongoing maintenance? Thank you.
Okay, thank you very much. So just to optimize time and process, I'd like Muni to address 2 issues. speak on manufacturing opportunities from a capital markets perspective. Dr. Adedipe will also talk about it from a broad economic perspective. And can you also speak to the cryptocurrency alternative asset class? Thank you.
Okay. And I will add the third one, the FPI.
Okay, yes, FPI. Very quickly, please. 3 in 1.
So the FPI, like Rachel just said, we are in a global competition. We engage investors not just in Nigeria. We keep on engaging investors worldwide for the various funds that we have. And when we are engaging investors, it's not just Nigeria presenting whatever investment solution to them. We are in competition with the entire world. So what we need to do for FPI, one key area is reform, transparency, efficiencies. For example, GIPS adoption of some global investment performance standards, good governance, obviously, all those kind of things that unfortunately we know we should do, we should be doing, and we are not implementing. So that's one. Because just increasing interest rates high, like, Fisayo showed during her presentation, you will get inflow, okay? They will make their return and they will leave very quickly. They will not stick for long because they know that as long as the structural reforms are not there, that small chart that she showed, that small bar yellow, will remain, the yellow one, the FDI, will remain very low. So that's one. But again, I would like to praise the CBN leadership. At least they have solved one issue, which is FX availability. People can come in and out. Okay, access to FX is easier. That's one. 2, on the crypto side, basically, there are various regulators in Nigeria who are involved within the capital market. And as it is as of today, there is no clear agreement between all those regulators. So we are involved. We have ongoing engagement with all the regulators that are involved. So of course that means Security and Exchange Commission, the Central Bank of Nigeria. So we are engaging them. As it is today, we don't have any solution because our job is not just to provide something that will be ineffective. We are here, to create and build wealth, not to provide access to anything that is just pure speculation and volatility. But nevertheless, as soon as there is an agreement between all the regulators and we can find something or create something, structure an investment solution that makes sense in the wealth creation journey, obviously, ARM will be here. And the last part
you said manufacturing.
Manufacturing.
Investments.
So manufacturing. So yeah, the gentleman mentioned, for example, access to FX, and I think that CBN is working on this. We know also that one of the challenges that manufacturing, especially the medium and small enterprise, have is access to funding. This is also an area we are working on. It's one of the alternative funds that that will come very soon. So very, very soon, probably your relationship manager, your financial advisor will reach out to you because we intend to go into that space and capitalize, because there are opportunities we know, and we'll be able to basically capture those opportunity on the manufacturing side.
Okay, thank you very much, Dr. Adedipe. I'd like you to take on the question around mining as an alternative FX revenue generator for Nigeria.
All right, thank you so very much.
Maybe comment on manufacturing, if you like. Yeah.
Okay. There are actually many alternative sources of foreign earnings for Nigeria. And that has been a conversation ongoing for, let me say, decades now, not even years. And if you look at the port, let me use the word port, there is, yes, oil earnings, which accounts for about 90.1% of our foreign earnings, okay? So, but over the years, if you look especially in the last 7 years, 2017, 2018, there has been significant increase in non-oil revenue. There's no doubt about that. In fact, that is what also underlines the increase in the budget for this year by the president last week. So about 4.4 trillion naira, because some components of non-oil revenue had increased. So what those of us who advocate on policy have been doing is it's not only about mining, okay? Mining as conversation in Nigeria that have been personally involved began in 1999. And the whole idea simply was that if you mine, let's say, 1 metric ton of any mineral, to start with, you are expected to pay 5% royalty to the government before any other thing at all. So we've advocated that if Nigeria pays attention to that, mining can actually become a major contributor to our foreign earnings. That's on the one side. Now there are several others, okay? But the whole idea, in fact, if you look at the digital space, for example, what is happening there in the digital economy is very significant. That again, at least in 2024, brought in about 2.4 trillion naira. That all of these foreign entities that were operating outside, they're making money from here, now had to drop in government coffers. So in fact, I mean, if you have any Zoom account, for example, just to make it simple, you notice that recently, when your invoice comes from Zoom, it carries a tax component. So in which case, for every month I pay subscription to Zoom, we have 2 accounts in BA Consult. Every month we pay, there's a line there that says the tax that goes to the Nigerian government. So the Nigerian government is making USD because Zoom charges me in USD. So I pay them in Indian companies in Nigeria. And they are commission in December. Indian companies in Nigeria. And they are commission in December. So most of the time, we complain about challenges in the environment. But these people talk about how to build a strategy and take all these challenges as given. And so they are making money, and that is what they tell you when you go into private conversation with them. So my own advice is, take a look at all those challenges we talk about, but train your mind to see opportunities, and when you do that, you are unlikely to surrender to or complain about problems. That's the way I will leave it.
Thank you very much. I think that was very apt. Before we come to Rachel to help us wrap up the panel, I just want you to say one thing on the tax reform bill. Just one thing, if you can. I know it's a very complex and extensive piece of legislation, but just one thing.
Well, I will say it's Nigeria's game changer.
Okay.
I mean, I've been in that space for almost 41 years now. It's a game changer for Nigeria. Never in Nigeria's history have we done tax reforms that is as deep as this. But interestingly, also giving room for SMEs and low-income earners to breathe.
Okay.
I will leave it
So it's a progressive tax system. Thank
It
you
is.
very much. Okay. Thank you. So Rachel, there was a question asked around infrastructure, sustainability of infrastructure, maintenance of infrastructure, and its use in productive sectors like agriculture. There was a reference to post-harvest losses. Can you tell us about some of those long-term infrastructure management risks and what your experience has been?
Thank you. So there are 2 cases. If that infrastructure has been built by the private sector, sustainability in the way you've described it is embedded into it. It goes even beyond that. It goes into the financial sustainability because without that asset, you do not have any revenue. So it is key for that asset to be performing and to be performing efficiently so that you can reap the benefit of your investment. When it is done, or traditionally when it's been done by government, and that's not just specific to Nigeria, it's been the same worldwide, there has been instances of lack of maintenance and lack of reinvestment into the asset to maintain it and ensure that the efficiencies that I mentioned earlier are maintained. What we see happening now more often is what is called asset recycling, whereby the private sector, in whatever form, it could take the form of a concession, it could take the form of an outright sale, but the public sector is handing over those assets to be maintained by the private sector, which often have the best abilities to do so, not just technically, but also financially. And so we encourage, and it's been done especially when it's a critical asset, to bring the private sector in. But again, it takes us back to having an environment that enabling that capital to come in. So that's what I can say about it.
Okay, thank you very much. A round of applause for the panel. I want to thank Dr. Adedipe for your macroeconomic insights. I think it's very interesting to hear your, I guess, cautious optimism, or should I say very bullish optimism, if I'm allowed to say that, around Nigeria's economy and our key macroeconomic indicators. So thank you very much for the insights shared, and Rachel for your expose on the infrastructure opportunities and the ways both the public and private sector can come together to really de-risk it as a viable long-term option to also contribute to economic development, and especially the focus on the energy sector as a key catalyst for all other types of infrastructure. And finally, to our investment guru, Muni Baba of ARM, thank you again so much for offering insights as to where we should pitch our tent this year if we're looking to reap returns in a volatile, but I would say an emerging and thriving economy. Distinguished ladies and gentlemen, it's been my pleasure to moderate this esteemed panel. Please give them another round of applause. If you haven't had time to engage, please do some post-event networking. And at this juncture, I'd like to invite the Group CEO of ARM, Jumoke Ogundare, to give some closing remarks. Thank you very much. I think we'll do a group photo once she's done with her. Oh, actually, I think they said Raphael was meant to talk a bit about ARM. Oh, you'll cover it. Okay.
We decided to say that a bit about ARM because we know that we've taken a lot of your time since the start, a little bit late. So I'm just going to cover that section a little bit. I really enjoyed this morning, and I wish we could spend the whole day talking about Nigeria, the opportunities, and you know, I do hope that you have enjoyed as much as I have. What I particularly liked about all the deliveries, and thank you very much to our panelists. We couldn't have chosen, you know, better people. And thank you, Rolake, excellent coordination from you. Thank you very much. But what I really liked about today's session is the simplicity of it. I was able to relate to everything that was said. And I do hope that you also found that to be the case, because I know that we are all from different backgrounds. But I do hope that you really, truly enjoyed it. You know, just listening to everything that I said today, and as I said, I wish we could have continued all day. It just tells you that there's a lot of opportunities in Nigeria. So many opportunities, you know, from everywhere. And, you know, we can talk about it. One thing that we're very good at in Nigeria is talking. We talk. You know, we can talk about it. And we can write. And, you know, every year we have this economic summit. We come together. We talk about great ideas. We go away. And the next year, we're in our suits, looking nice. We talk about it again, and then we go away. But you know, until we start doing something about it, it's not going to change. Sometimes I say to people that if you take Nigerians out of Nigeria and bring Germans into Nigeria, in 2 years, everybody will come to Nigeria. Because we have so much. The resources that we have, not only natural resources, we have human resources, very rich human resources, interaction with Nigerians all over the world. If you look at, you know, our positions that Nigerians fill in different parts of the world, significant positions, and at home as well. So the resources are there. And, you know, ARM turned 30 years last year. And if you look at the history of the organization, at every point in time, we pause to look at what we're doing, how we're doing it, and we then take, you know, make some decisions. I think in the early 2000s, we, you know, everybody at that time, and unfortunately we're still doing it, but maybe less so now, but everybody at that time talked about infrastructure. If you were in a gathering and you just go to 2 or 3 groups, what they'll be talking about is either power or road or something that is not working. So in early 2000, we got the opportunity to look at infrastructure. Not only talk about it, but to actually do something about it. In the hope that if we do it well, then others will come into that field and we'll do it. Because as Dr. Takant said earlier, and Rochelle spoke to in her the session, we need to do things at scale. With over 200 million people, one organization cannot make that change. We need to come together to do things at scale. So early 2000, we looked at infrastructure and we decided to do something about it. And we started with the rehabilitation of the Lekki-Epe Expressway. And from there, we went into, we developed an infrastructure fund, which Rochelle now heads. But, focusing on how we can help to improve the quality of infrastructure in Nigeria. From there, today, I think in Nigeria, we have several infrastructure funds doing similar things. But we still need a lot more. So last year, again, we looked at the environment, and we decided that there were other things that we could do, other areas that we can make an impact. And that if we do those things very well, others will come into the space. So Monir talked earlier about what we're doing in the food area. Food, many, many, many years ago, before we discovered oil, food was Nigeria's main source of income. When I was growing up, we had pillars of cocoa, you don't even see those things anymore. So really, we need to go, but not only just producing, but we also need to process. Because I relate food, the way we treat food here, as the same way you look at oil. So we have the crude oil, we export it, and then we bring the refined oil in. We have cassava, we export it, and they come back with starch or what. And, so really we need to do a lot more. And so we decided to set up a food fund so we can address this. Likewise, we have what we're doing in the infrastructure space. We're looking at, and very soon we'll be announcing, setting up a private debt fund. Because, one area that has not been given enough attention in Nigeria, and it's not only Nigeria, it's all over the world, is the SME space. Where, we have a strong financial services sector, but not enough is being put into the SME space. And, it's strange because the SME industry is what is actually contributing the most to growth in Nigeria. So what we're trying to do now is set up a trade fund. We're also setting up a private debt fund to help catalyze growth in the SME space. And we hope that, other players can side and we can truly make, an impact in Nigeria. There are other initiatives that we're coming up with because we've looked at the different segments. Which areas can we meaningfully intervene in to make a difference, to drive growth and bring others along, with us? Of course, we need the government. As Dr. Takan said earlier, we need the public sector to work with us. We've been in the real estate space for some time through our today mixture. And, it's a tough space. And it's tough because there is no mortgage. I remember during the Obasanjo regime, we tried to set up a mortgage market at that time. But it was so difficult. So that we're able to achieve something, it's a start. It's not going to solve all the problems, but it's a start. And hopefully, as we develop MRIF and people benefit from it, other initiatives will also come. So ladies and gentlemen, thank you very, very much. A lot has been shared with you this morning. But I would ask that you please, if you can wait around, some of my colleagues will be around to talk to you a little bit more about your own specific problems. Because what we've talked about are the general issues. But we know that specific to you, there are things that you would like to talk about, either about your own personal investment or about, your business. If you're not able to stay, I assure you that over the next few weeks, we will be coming over to meet with you to talk about what ARM is doing, but specifically to talk about how we can help you to meet your financial ambitions. Thank you very much, and have a good day.